Hi friends, my name is Nilesh Phadke, your learning partner in finance and accounts. In this video, we will learn mainly about the preparation of the profit and loss account and balance sheet and the associated journal entries. Whenever businessman starts any business, he makes sales, incur expense, and at the end have some profits from the business. This is basically recorded in profit and loss account of the statement. At the same time, he takes bank loan for the business, make investment in FDs or other assets, also buy some computer and equipment, plant and machinery for the business. All these transactions are recorded in the books of accounts in the form of journal entries. So let's understand how to file journal entries and prepare profit and loss account and balance sheet with an example. So here we go. Cash sales made during the year rupees 10,000 and we need to pass journal entry of the same. Now let us first see its impact on profit and loss account and balance sheet. Now sales appears in profit and loss account under the heading income. So rupees 10,000. So total income is 10,000. There is no expense. So profit, that is A minus B, is 10,000. Opening profit, that is profit of the last year, is dash. So retained earning, that is accumulated profit, is 10,000, which can also be calculated as C plus D. C plus D. Now this retained earning appears on the balance sheet liability side, rupees 10,000. And due to cash sales, balance sheet asset side increases by rupees 10,000 as there is an increase in cash balance. So balance sheet liability side 10,000 and balance sheet asset side also 10,000 and our balance sheet tallies. Now let us pass journal entry related to this. Now cash balance on the balance sheet asset side is increasing by rupees 10,000. Now cash balance appears on the balance sheet asset side which is increasing. So rule is aid, that is assets increases debits, and hence cash balance will be debited by rupees 10,000. On the balance sheet liability side, retained earning is increasing by rupees 10,000. So rule is LIC, that is liability increases credit. So retained earning will be credited by rupees 10,000. However, whenever retained earning comes into a picture while passing journal entry, you do not directly write the word retained earning in journal entry. Rather than you write a transaction which is affecting this journal entry, that is sales in this case. You can check here. Due to sales, the retained earning has increased to 10,000 and hence sales account will be credited by rupees 10,000. Narration being cash sales made by the company during the rupees 10,000. Credit sales made by the company during the year rupees 20,000. Now sales appears in profit and loss account under the heading income side. So total income is 20,000. There is no expense. So profit is 20,000. There is no opening profit. So retained earning is 20,000. Now this retained earning appears on the balance sheet liability side. So 20,000. At the same time, on the balance sheet asset side, debtors is increasing as receivable on account of credit sale to the customer. So debtors balance on the balance sheet asset side increases by rupees 20,000. So total asset 20,000, total liability 20,000 and our balance sheet tally. Now journal entry for the same is as follows. Now debtors account will be debited by rupees 20,000 based on the rule of AID, that is AID, that is assets increases debit. And retained earning account will be credited based on the rule of LIC, that is liability increases credit rupees 20,000. However, whenever retained earning is affected in any transaction while passing journal entry, you do not directly write the word retained earning. Rather, you write a transaction which is affecting this retained earning, that is sales in this case, and hence sales account will be credited. Narration is being credit sales made by the company during the year rupees 20,000. Sales made by the company rupees 50,000, out of which 30,000 is cash sales and 20,000 is credit sales. So in profit and loss account, sales is recorded rupees 50,000. Total expense is 0. So profit, that is A minus B, is 50,000. So retained earning is 50,000, that is C plus D. Now this retained earning appears on the balance sheet liability side as 50,000. So total liability side is 50,000. However, cash is received only to the extent of 30,000. So cash balance is 30,000 and remaining is the receivable from the customers, commonly called as the debtors in accounting language, rupees 20,000. So on balance sheet asset side, debtors 20,000, balance sheet asset side cash 30,000. So total assets is 50,000 and total liability is also 50,000, and thus our balance sheet tallies. Now journal entry, debtors is debited by rupees 20,000 based on the rule of AID, that is assets increases debit, and hence debtors account will be debited by rupees 20,000. Cash also appears on the balance sheet asset side, which is increasing by rupees 30,000. So rule is AID, that is assets increases debit. So cash account will be debited based on the rule of assets increases debit rupees 30,000. On the balance sheet liability side, retained earning is increasing. So liability is increases. So rule is LIC, that is liability increases credit. So retained earning account will be credited by rupees 50,000. However, whenever retained earning is affected in any transaction, you do not directly write the word retained earning in journal entry. Rather, you write a factor which is contributing to retained earning, that is sales in this case, and hence sales account will be credited rupees 50,000. Entry is being cash and credit sales made by the company during the year rupees 50,000. Cash purchases made by the company during the year rupees 5,000. Now purchases appears as an expense item in profit and loss account, due to which total expenses is 5,000. There is no sales, so profit is minus 5,000. Assuming opening profit to be 0, so retained earning is minus 5,000, that is C plus D. Now this retained earning appears on the balance sheet liability side. So balance sheet liability side is minus 5,000. At the same time, cash balance of the company reduces due to purchases. So cash balance is minus 5,000. So total asset minus 5,000 and total liability is also minus 5,000, and thus our balance sheet tallies. Now let us pass journal entry related to this. Now liability is reducing by 5,000. So retained earning is reducing. So rule is liability reduces debit, that is LRD. Therefore retained earning account will be debited by rupees 5,000. However, whenever retained earning is affected in any transaction, while passing journal entry, you do not directly write the word retained earning. Rather, you write the word a transaction which is affecting this retained earning, that is purchases in this case, and hence purchases account will be debited by rupees 5,000. At the same time, on balance sheet asset side, cash is reducing. So rule is assets reduces credit, that is ARC, that is ARC. That's why cash balance account will be credited by rupees 5,000. Narration is being cash purchases made by the company during the year. Purchases made by the company during the year rupees 18,000. Now purchases appears in profit and loss account as an expense. So total expense is 18,000. There is no revenue, and hence profit is minus 18,000, and hence retained earning is also minus 18,000. Now this retained earning appears on the balance sheet liability side, and hence it is minus 18,000. Due to credit purchases, company has not paid from bank or cash balance of the company. Rather, payable in the form of creditors is created on balance sheet liability side. So creditors on balance sheet liability side is plus 18,000. So minus 18,000 plus 18,000. So total liability is 0 and total assets is also 0, and thus our balance sheet tallies. Now retained earning on balance sheet liability side is reducing by rupees 18,000. So rule is LRD, that is liability reduces debit. So retained earning will be debited by rupees 18,000. However, whenever retained earnings affected in any transaction while passing journal entry, you do not directly write the word retained earning. Rather, you write the transaction which is affecting this retained earning, that is purchases in this case, and hence purchases account will be debited by rupees 18,000. At the same time, on balance sheet liability side, creditors is increasing by rupees 18,000. So rule is LIC, LIC, that is liability increases credit, and hence creditors account will be credited by rupees 18,000. Narration is being credit purchases made by the company during the year. Thus, we have passed necessary journal entry for credit purchases by the company. Purchases made by the company during the year rupees 20,000, out of which cash purchases are rupees 12,000 and credit purchases are rupees 8,000. Now purchases recorded in profit and loss account as an expense 20,000. Thus the total expense is 20,000 and profit is minus 20,000 as there is no income. Opening profit, that is profit of the last year, assumed to be 0. So retained earning, that is C plus D, is minus 20,000. Now this retained earning appears on the balance sheet liability side, minus 20,000. However, cash paid is only 12,000. That means cash balance reduced to the extent of only 12,000 only. So minus 12,000. And remaining 8,000 is payable to the creditors as the payment for the same has not yet made. So creditors on balance sheet liability side is 8,000. So balance sheet liability side retained earning minus 20,000, creditors 8,000. So total liability is minus 12,000. On the balance sheet asset side, cash balance is also minus 12,000. So total assets minus 12,000, total liabilities minus 12,000, and thus our balance sheet tallies. Now let us pass journal entries. Now retained earning is reducing. So rule is LRD, that is liability reduces debit. So retained earning account will be debited by rupees 20,000. However, whenever retained earning is affected in any transaction, you do not write the word retained earning in journal entry. Rather, you write a transaction which is affecting this retained earning, that is purchases in this case. So purchases account will be debited by rupees 20,000. Now cash balance on balance sheet asset side is reducing by rupees 12,000. So rule is ARC, that is assets reduces credits. So cash balance account will be credited by rupees 12,000. At the same time, on balance sheet liability side, creditors is increasing by rupees 8,000. So liability side is increasing. So rule is LIC, that is liability increases credit. So creditor account will be credited by rupees 8,000. Narration is being credit purchases made by the company during the year. Thus we have passed the necessary journal entry. Thus to conclude, what we can say is that as a first step, you have to identify whether an item appears in profit and loss account or balance sheet. Once you identified it, based on the rule of AID, ARC, LIC, LRD, you can pass any type of journal entry. So let's understand these rules. First rule is AID, that is AID, that is assets increases debit. Second rule is ARC, that is ARC, that is assets reduces credit. Third rule is LIC, that is liability increases credit. And fourth rule is LRD, that is liability reduces debit.